everyone, and welcome to another The Thai Innovator webinar series. Today, I'm very excited to be joined by Function, FBTC, and Marinade Finance. We'll join by, and as well as Maple, so we'll join with Thomas Chen, CEO at Function, Hadley Stern, COO at Marinade Finance, and Sid Powell, CEO and co-founder at Maple Finance. Today, together, we'll explore the ever-evolving landscape of institutional adoption in DeFi, from current challenges to regulatory shifts, which have been quite intense recently, to technical innovation and what's enabling greater participation in the ecosystem. We'll discuss how institutions are engaging in DeFi, what they're doing, the infrastructure improvements that are driving that adoption, and what the future holds for the intersection of traditional finance and decentralized protocols. So without further ado, let's dig in. Oh, one more thing. We'll do our general disclaimer. So as you know, all the information contained in this webinar is for informational purposes only and not intended as investment advice. With that said, let's get started. So Thomas, let's start with you. Could you please tell us a bit more about yourself, about Function, and what your journey in the DeFi space has been?
Yeah, of course, Sacha. Happy to be here. Thanks for having me and excited to kick things off. So my name is Thomas Chen. I'm the CEO of a company called Function. We're a little bit newer in the space in terms of name, but we've actually been around for about a year now. Quick background about myself, and I'll get into a little bit about how we, kind of our journey through DeFi to date. So previously, I spent about 7 years, I know, a very long time, at BitGo, running global sales, grew the custodian to over 100 billion in AUC and 50 billion in assets under staked. I also did all the fun stuff at BitGo, which to me is all the DeFi, crypto native, and projects like WBTC. And I had one observation when I was there, right? The single observation that I had that was piqued my interest was there was about, call it, 30 to 40 billion of BTC doing nothing but paying custody fees, right? And if you extrapolate this, it's probably the same magnitude amount at the other custodians, other wallets. So the journey into DeFi really began with one question, which is, if Bitcoin is the most valuable asset in crypto, why is it one of the least productive on chain? To me, the vision of the space in 5 to 10 years, I believe Bitcoin will become a reserve asset for DeFi. In order for that to happen, it has to be able to move freely, right? So that's what we're doing at Function. We're trying to build functional asset for BTC. It's called FBTC, fully liquid, highly composable, and capital efficient. So it's really an infrastructure play. And then I just summarized this with, we are backed and incubated by some of the largest strategic names in the industry, including Galaxy, Antalpha, and Mantle. And today we've got about 15,000 BTC in TVL, which is about 1.3 billion.
Impressive. Awesome. And then over to you, Hadley. Would love to hear about Marinade Finance, and also tell us a bit about what differentiates your approach for institutional users.
Sure. Great to be here. Thank you for having us. So yeah, I've been at Marinade over a year, but been in this beloved space for, I think, 10 plus years now. Was very part of the early team at Fidelity Investments, helping stand up Fidelity Digital Assets, and also was at Bank of New York Mellon. And came across Marinade. I've been very into Solana since the beginning. So Marinade was very early in the Solana ecosystem, basically created the first liquid staking token called MSOL that allowed people to stake on Solana, and now has grown to about 2 billion US total value locked up on the platform. And in the past 12 to 18 months have really started to focus on the institutional market, as we've seen staking become much more of an opportunity for the institutional market. One of the unique things about Marinade is we actually don't run any validators ourselves, which often catches people a little off guard. Instead, when people stake their Solana with us, we distribute that to over 100 validators based on getting the highest performance and highest return, which basically ends up with a reward yield that's about 50 to 100 basis points higher than someone running a single validator. And this is obviously, very beneficial to our end clients who are very interested in staking yield and staking volume. And on the institutional side, we're just getting going in the UK, integrated with Zodi and Copper. We're very shortly going to be launching with BitGo, first US qualified custodian, and very excited about that. And one of the things I think that's interesting about staking is, yes, it's about yield, but it's also about the underlying infrastructure of these proof of stake networks. So when I think about how we'll think about staking, 5 to 10 years from now, I think we'll look at it as this institutional layer that's a critical transaction layer and completing transaction layer across blockchain networks. So this isn't just about reward, it's also about making sure that networks like Solana are decentralized and sturdy for the long term.
Awesome. Thanks for the introduction, Hadley. And now, finally, last but not least, Sid. So tell us a bit about Maple Finance, your journey, and how the recent launch of Syrup fits into your vision for bringing DeFi to an institutional audience.
Yeah, thanks for having me here, Sacha. So Maple's an institutional lender. So we originate loans on the blockchain using stablecoins. The vast majority of our lending is over collateralized. So we take BTC, ETH, SOL, XRP from our clients as collateral. And on the other side of that is a yield product. So we serve hedge funds, high net worths, family offices. And then with the launch of Syrup, we serve the broader DeFi market. So Syrup USDC is it's effectively permissionless distribution for the institutional lending product. So it means that somebody in Argentina who might be a smaller investor or allocator can participate and get access to these institutional yields. We've also had partnerships with Pendle, which these kind of DeFi integrations we consider extremely important. And there's actually a forum post up at the moment to integrate us with Sky. I have the fortunate privilege of being a client of both Marinade and soon to be Function. So the other aspect that we've done at Maple has been we launched recently a Bitcoin yield product in partnership with Core ecosystem. So this offers Bitcoin yield on Bitcoin through staking rather than lending or taking significant counterparty risk. And indeed, this is done in partnership with custodians like BitGo, like Copper, and Anchorage, who folks are very familiar with. My background, though, just give a little bit of an introduction, was banking. So I used to work in securitization at National Australia Bank back in Australia, and this meant working with a lot of lending companies to issue asset-backed bonds on chain. So that was the initial idea of Maple, was could we do bonds, tokenized bonds? And where we've evolved to since then has effectively been a kind of form of tokenized private credit. We currently sit at about 750 mil TVL or assets on the platform, and we've done over 6 billion in loans since we launched about 4 years ago. So very happy to be here, but I'm a big proponent of institutional adoption, and I think this year with the regulatory tailwinds behind the space, we just find a much more receptive audience among institutional allocators and Wall Street. You've seen Cantor Fitzgerald say that they were interested in lending against Bitcoin, and I think that's only the first of a big foray from institutions into the space.
Mm-hmm. So actually double clicking on this, to all of you, what initially attracted your organizations to focus on institutional DeFi adoption, right? And how has that evolved over the years, especially over the past year, I guess?
I can talk about the lending side first. We kind of meandered around different business models at first. I've seen there was a really good article on kind of working your way through the idea maze. And for us, it was working our way through the idea maze at Maple that brought us to institutions. Me and my co-founder initially began by doing like peer-to-peer lending on chain. And that's just it's a very tough business to be in. You need regulatory licensing. You're taking different kinds of credit risk, and your business just needs to be structured to support a lot more customer service when you're dealing with kind of smaller clients and retail clients. Whereas with institutions, we found it to be just a much more scalable business model, and institutional credit or lending was kind of what we were used to coming from traditional finance. So where we've evolved to today, the attractive part of institutions is, they have cash flows that you can lend against. They can take down loans, or they can participate in asset management in size, and so you can run a much leaner organization while still sort of taking the right amount of fees to operate and grow your business.
Yeah, I think for us, apologize for my dog, can't decide whether she likes DeFi or not. I think for Marinade, look, we're running a business, right? And so it's very much about where the demand is and where the total value that we can add to our network is. And so in many ways, it was listening to the market signals that were coming from institutions. As I said, I've been involved in this space since 2014 when it was just Bitcoin, and Bitcoin went through its whole journey of institutional adoption, then followed on by Ethereum more quickly. And I think as this space matures and institutions become more familiar with blockchains and what they are, you're seeing an acceleration, and that acceleration goes into DeFi with the things like Sid is doing at Maple and Thomas is doing with Bitcoin, and what we're doing with Solana. So in many ways, it's a market response where institutions are understanding these technologies, not only from the aspect of how they can make money from it, from a market making potential, but also how they can use this technology to distribute real world assets on chain. Like BlackRock, I believe, was just announced yesterday, released their Builder product on Solana. So this is largely coming from institutions.
Yeah, I see commonalities across the three of us. We're both either TradFi or Trad crypto guys, right? But the commonality is we're all focused on market structure. Having started at BitGo, I had a front row seat in everything that was going on back when DAOs were still very popular, all the way to talking to some ETF providers back in 2020 at the beginning of their journey. So I think the other thing that's not said is crypto, as we know on the retail side, is very, very narrative driven. And these narratives shifts from something shiny season by season, and it's a little bit played out on the memes and the points. And frankly, I think it's just exhausted. And it's at a point where my observation is the crypto native space iterates quickly, which is amazing. But the liquidity that comes into that space to be iterated on with new DeFi primitives is capped, right, based off of new entrants. So you're almost waiting for the institutions to come in, starting with things that they're familiar with, right? Bitcoin or staking or lending in a secure way, in a compliant way to get them and get new liquidity into the ecosystem before we can continue to iterate on those types of things in the form of structured financial products.
Yeah, so let's start to dive first in, what's the current state, right? And then we'll look at more what's the technical state, and then, other type of use cases. But first, let's focus on what's going on now. So how would you characterize the current state of institutional adoption in DeFi, right? What are the significant developments that you've observed in the recent months? How is it going? Any blockers? Where is that going?
I'll just give a quick take and I'll pass it to Hadley and Sid here. So I left BitGo 2 months ago. So still pretty fresh. But if we look at it from the lens of a custodian, I think it's important to start there, because you want to start where the money's being held, right? You start from where the money's being held, and then you trace it to, okay, what can I, now it's here, but what is the utility? What can I do with this, right? These are all the questions that the institutions are asking. So I think they've already checked the box on, okay, we trust that there's reliable wallet infrastructure. I've observed the space. Now they go into exploration, right? I think we can see trends of institutional vault providers recently raising capital, a lot of these L1s or L2s pivoting to start to cater to institutions. So the shift isn't just the interest, but the infrastructure readiness, starting with custody, compliance, composability, all improving, with the likes of FBTC for the Bitcoin side, Maple agnostically on the institutional lending, and of course Hadley on the staking side as well.
Yeah, I would characterize us, and this is what makes this industry so exciting, as exceedingly early. I kind of think about institutional adoption in terms of how much financial activity in TradFi is happening on chain, and it's de minimis right now, but that's what makes it so exciting for what all three of us are building here towards this future. So I think if what Thomas's vision is to activate Bitcoin and make it something that can be utilized in DeFi, that's just getting started. What Maple is doing on the innovative side in terms of DeFi trading and those types of systems, just getting started. And what we're doing in staking, but it's very early. And so, probably the strongest example is beloved stablecoins, where they're actually getting, institutional usage and adoption. You have Bank of New York Mellon that is the lead treasurer for Circle, which is very interesting. And you see them also doing some more things in that product space. So early, but that's what makes this so interesting.
Yeah, I certainly wouldn't deviate from the interpretation that it's early. I'd say what we're seeing on the credit and lending side is, as I mentioned before, more interest from traditional Wall Street firms or asset managers in credit and yield products. And I think the major blocker was regulatory, which I think has been removed. So now we're starting to see more interest in participating in the space. And then I think, but this is typically more like your sort of your larger institutions. And I think some of the blockers are custody. So if they're lending, where do they custody the assets? They partner with somebody like a BitGo or an Anchorage, do they lend and try and offer the custody service in-house, like maybe a Fidelity might consider. And then I think the other blocker is so the key blockers are kind of regulatory, legal side, custody side, and then the other one is just it takes them time to kind of build a network. So we're seeing the first entrance in the space, but I would be surprised if there was not, if Ares, Apollo, and a lot of these private credit shops did not enter over the coming years. And for us, we kind of look at that as it's a double-edged sword. It implies more adoption and assets moving on chain, but also implies more competition and means that players like us and others who are doing lending today are going to have to continue to adapt.
I have one more quick comment to add to this. In addition to what Sid said about the tailwinds coming through, there's also downward price pressure on revenue for custodians. What I mean by that is, I think what you'll start to see by the end of this year is everyone's going to come out with some sort of yield marketplace front-end user experience. And I think that's because as there's custody gets commoditized, wallet providers, custodians have to move up the stack, right? So they constantly figure out how to get to higher margin products, a la staking, a la borrowing and lending. So these integrations, and they don't want to build it themselves, right? But they want to build this ecosystem and network effect that Sid described, but they want to keep the assets at the custodian. So I think we'll see a lot more build of the value stack towards these type of products.
Yeah, I also think one more thing to add is I think you see more M&A activity by traditional players because they've been kind of held up from participating, like things like SAB 121. Banks couldn't custody crypto assets. But now that they can, they're going to face a question of like, do they just try and buy something to get to market as quickly as possible, or do they try and build it themselves?
Yeah. I mean, and this is also like even more fuel to the fire, which is even in traditional finance, M&A activity is picking up. So, and so what is the feedback that you're getting from institutional clients about how they approach it? How they approach entering the DeFi ecosystem? What type of primary concerns do they have? Is it risk-based? What are these concerns?
All of our conversations typically with institutions, when speaking about staking, there's three things they're concerned with in this order. The first is regulatory status. So what is the regulatory status of the product? Second is security. What is the security model, custody, non-custodial, who has control and access? And then finally, what is the yield for the product? So, the 1 and 2 are still critically important. 1 has obviously changed with our election and, the new administration. security, I don't think ever changes. That's going to be a continually evolving issue that as an industry, we just always have to keep our eye very solidly on. That's our experience.
Yeah, it's mostly risk-based from what we see. So, firms are concerned about counterparty risk. If they participate in DeFi, do they put their assets in a smart contract? How secure is that? What happens in the event of a default? Because these are all the questions that typically go into counterparty due diligence when you're in traditional finance. If you put your assets with a clearinghouse, or if you trade with a counterparty, is there a clearinghouse involved that can separate out the counterparty risk? That doesn't exist as much in DeFi, notwithstanding that you have things like atomic swaps. But it's for us, that's the primary one, and then the secondary one is things like KYC, that type of thing. Although I think now there's plenty of solutions, and the idea of kind of permissioned DeFi is fairly well trodden. So I don't know that that's as big a blocker as it perhaps once would have been.
Yeah, I think in the life cycle of how an institution approaches this, right now that they're in the exploration phase, it's all right, let me identify the yield. Now that I've identified it, let me figure out how to access it. And I think that's where Maple, Marinade, and us play, right? The accessibility, that infrastructure. And then, of course, third is like, how do I manage the risk on that yield? I think we're at a point, this is kind of funny. I think the DeFi space, for all its grandeur and beauty and smart contract, et cetera, institutions still have a hard time figuring out how to underwrite smart contract risk, right? So you almost need to go in with something in between. It sounds silly, but like these simple but dumb but like proven legal structures like an ACA to get them comfortable, right? It just works, right? The due diligence already passes. They know how to underwrite it. They know the counterparties, the SLAs, et cetera. From a Bitcoin perspective, I'll share this. I had canvassed a lot of the clients, and whether it's an exchange or a family office or an asset manager, they cared about three things, right? Again, this is from a Bitcoin perspective, but I think it could be extrapolated to other assets as well. The first question they always ask is, how's my Bitcoin secured? Where's it being held, right? Number two, is there efficient liquidity, or is there a sustainable and scalable way for me to deploy the BTC? Deploying 100 BTC, maybe for a pilot, but it's not that interesting. Doesn't move the needle. How would I do 1,000, 3,000, right? 5,000 BTC? Maybe DeFi just doesn't have the capacity today, right? And the third one, of course, is I want my rewards in kind or in stables. From risk perspective, or just how they manage a treasury, they're not that interested, as far as I've seen, in too many altcoins. So they're called the longer tail coins. So how do we revert it back to the in-kind asset that they hunt the yield for?
Sorry, I was muted. Yeah, no, that totally. And you touched a little bit on some of the regulatory aspects, but maybe it would be good for the audience to recap a little bit of what happened in since 2024, and how is the regulatory landscape evolving for those institutions to start interacting with DeFi, and how much of a role that has played in the current adoption we're seeing.
Yeah, I can start on that one. I would say, just to kind of, it's probably worth contextualizing what the regulatory landscape looked like at the start of 2024. So banks were not able to custody crypto assets, because if they did, they would have to hold equity against it, which is not really how custody works from a business model perspective. So that was SAB 121. You had active litigation against, and some of it was created during the year of 2024, but you had active litigation against Coinbase, XRP, Ripple. Towards the end of the year, we saw Uniswap and OpenSea as well, and then indeed a suit against Kraken as well. So this covered everything from lending and yield, staking, just offering DeFi or other tokens to clients, with the default view being that everything was a security, every product on chain was a security, and there was really no pathway to registration. So it was like the idea that you would go in and register was kind of fraudulent, and not really sort of held out in good faith. So the idea was you would go in to like kind of talk about registration, and then you'd wind up with a lawsuit or a subpoena. So for TradFi institutions who are looking at the space, a lot of them have very large revenue lines that are in other products, and they were concerned when I would speak to them that if they were to do something in DeFi, they would fall afoul of the SEC, and that would jeopardize the mothership, 90% of their revenue. So it wasn't worth taking a flyer on a blockchain product or issuing that to their clients. So that has totally reversed now in 2024. So all lawsuits dropped, SAB 121 scrapped. Market structure bill is coming this year. Stablecoin bill is in progress. Change of leadership at the SEC to be more pro-innovation, and with a real mandate that they actually want this to, want crypto innovation to occur onshore rather than being pushed offshore. So it's totally the regulatory posture is kind of totally flipped. And we're seeing that now in conversations with the institutions where they're saying, okay, well, like maybe we can offer this to our clients, or maybe we can partner in some way, or or participate in some other fashion. And so I think it's been a total game changer.
Yeah, it's shifted from skeptical to strategic now in a lot of the firm's eyes. And I think we always talk about operational choke point, but I think the real world effects of that downstream and the day-to-day trenches of what we're living in is for these large institutions to onboard large infrastructure players in crypto that are established and may have linear effect. Well, guess what? Those guys may not be able to get the tier 1 US banking rails, right? Just by nature of operational choke point in the previous administration. So that had also been behind the scenes when it comes to due diligence with larger traditional financial institutions. Their, call it treasury due diligence teams. It was hard to get those conversations through as well.
Yeah, definitely a huge shift there. So we've covered, what the current state is. Now let's shift gears a little bit and look more technically what's going on. So let's start with you, Thomas. How does your omni-chain Bitcoin asset FBTC address that liquidity fragmentation issues that institutions are facing, especially when it comes to deploying capital across multiple blockchain? And how are you solving this?
Sure. So liquidity fragmentation is a major obstacle to institutional capital deployment, right? Because it creates capital inefficiencies, executional complexities, and yield fragmentation too, right? So it's just fraught with risk. If you look at the Bitcoin liquidity landscape today, you have WBTC, right? Kind of the dominant one, but WBTC is also fragmented. Maybe some of you guys don't know this if you're not active, but WBTC on Arbitrum, on Solana, on some of these other high TVL chains doesn't exist as a canonical one. It exists as a wrapped WBTC. So now you have double wrapped WBTC or BTC, right, on these chains. Or on other chains like Avalanche, they decided to create their own. So it makes it really hard to deploy capital. Yes, they have different use cases. So our vision is let's just start with FBTC and make it unified and be the functional asset for BTC, where people can enter in and explore all these different ecosystems, but it is united through a common standard.
And how about you, Hadley? How does your liquid staking protocol address the institutional requirements when it comes to capital efficiency and compliance?
Yeah, sure. And actually, that's something that we're trying to correct in the market, because we're not just liquid staking, we're also native staking. And we believe native staking is better for institutions. It's a bit of a nuance, but it's an important one. Liquid staking really was an innovation that came out of the Ethereum network, and it was kind of a have to, because on Ethereum, you, in order to natively stake, it's a minimum of 32 ETH, which depending on price is anywhere from 60 to 80,000 US, and then the unstaked time can be over a week. And Solana, it's a little different. It's you can natively stake a minimum of 1 sol with an unstaked time of a Solana epoch, which is 48 hours. So we did originally create MSOL to help address some issues, but given the fact that when you natively stake, you have no smart contract risk, and you're actually maintaining custody of that underlying Solana, the way the Solana protocol works with staking, we're working with a lot of institutions who are interested in native staking for that reason. Sorry, I forget the second part of your question.
Yeah, I mean, both, right? There's that aspect of, right, like lowering the risk, especially if you have the size to not have to deal with a liquid staking instrument, right? And you could go native. But also, how about capital efficiency and compliance for those institutions?
Yeah, so for capital efficiency, something we're introducing in the next 6 to 8 weeks is an instant unstake feature to deal with that 48 hours. So we're working with a couple of ETF funds, and funds have to be concerned with redemption and they want to have as much staked as possible. But that even though it's not a week or 10 days like it is in Ethereum, that 48 hours unstake time has an operational complexity. So we're creating something called instant unstake that will have market makers on the other side able to supply that liquidity for that 48 hours.
Super interesting.
Just to add to Hadley's point, I mean, we use Marinade as a product for staking some of the SOL collateral that we take, and I think another important point to note: one, liquidity is very important, but two, the fact that they're spread across many different validators. So when you use it as an institution, you're not taking the counterparty risk of like one party. You're actually like very well diversified across a portfolio of validators.
Interesting. Yeah, I mean, yeah. And how about you, Sid, was Syrup, where you're targeting permissionless access to institutional yields? How do you balance the decentralization with the need for high quality underwriting and collateral management for institutional lending?
I think we've taken a more pragmatic approach to decentralization over time. So when we began Maple, we had more of this kind of credit marketplace where you could have different underwriters effectively act as like portfolio managers for credit, and they could kind of run their own lending books. Over time, we've centralized that inside the Maple team. So we have our own underwriters who kind of approve all of the loans and manage the collateral underwriting. So we will take a week or two to do a collateral review before onboarding something, and we've had ones that we deliberately chose not to onboard because we weren't comfortable with the collateral risk. So we've found that has been super important for institutions because they like to understand how we go about managing the risk, and they like to talk to the people who are making the decisions. So we'll put them on calls. But the decentralized aspect is we really wanted to have distribution into DeFi. I think it's so important as a DeFi product that you're actually accessible by other protocols. So in our case, those partnerships include Morpho. So we got Syrup USDC, which is the LP token, added to Morpho as collateral, so people can use it to deposit USDC with us, get a yield on it, and then deposit that to Morpho to borrow against it and loop, which is positively geared because the rate they borrow at is lower than the rate they earn on Syrup USDC. And then Pendle allows people to kind of hedge the interest rate risk. And then we're currently in the process of going through a review with Sky. And so none of that decentralized distribution is possible unless you have kind of permissionless aspects to your products. I think that's the really important aspect is decentralized distribution and access to the broader on-chain allocators. You can see that as well in what folks like Apollo and BlackRock are trying to do. So BlackRock has indirectly got decentralized distribution through Athena and through Ondo, which both effectively package or wrap the product in a DeFi friendly wrapper. So Biddle has a 5 mil minimum, but if you access it through Ondo or through Athena, the average DeFi user can access it, and that helps. It's good for BlackRock because they get distribution and they increase their AUM, and it's good for the platforms wrapping it because they get the benefit of the brand name of BlackRock and the safety and perceived quality that goes along with that brand name.
Yeah, and as you mentioned, Biddle, right? Like they crossed a couple weeks ago or a week ago, the $1 billion mark in AUM, right? And that's going pretty fast. Great. And so let's do a quick round of what is for you, what according to you, what's the technical infrastructure improvement that's been the most critical for enabling the participation of institutional enterprises in DeFi?
I can start this one. So I view it again from a life cycle, but I think security, right? Institutional grade security infrastructure is going to be the most important thing that gets institutions comfortable to start dipping their toe in the water. So for us, that's from an on-ramp perspective is how do you get FBTC, right? Well, today you could get it through merchants that are on the platform, or you can get it through, we have Bybit as one exchange. We're looking at other exchanges for retail, of course. And then we're also working with custodians because we're trying to figure out, there's a lot of latent BTC at custodians, right? Whether it's BitGo, Anchorage, or wallet providers like Fortify and Copper and Fireblocks. Like, how do we get them to utilize the BTC without it necessarily leaving the ecosystem, right? Because the security is found within the wallet or the regulated custodian. Second one, of course, is the cross-chain. Like we've got a relationship with Layer 0, just being on the major chains where there's both users and incentives and kind of TVL is important to us. And then, of course, similar to Sid, right? What is the actual utility? So connecting to, we're working on Aave, right? Or the Avalons and connecting to the yield from Athena. Those are all things we think about.
Yeah, I think about it in terms of layers. And I think what's interesting is you've got different layers represented on this call that are each critical to institutional adoption. Well, I mean, we don't have anyone from an L1 here, but I can sort of represent Solana, if you will. I'd say there still needs to be this continuous innovation at the L1 layer for institutions to be comfortable to adopt this technology and do things like BlackRock did in terms of releasing Builder on a Solana blockchain. Then I think there need to be folks like what Thomas is building for Bitcoin at that protocol layer, what we're doing at the staking level. And then I think if I can talk a little bit about Maple, what I find really interesting is there needs to be this DeFi trading, lending, borrow layer that has to both speak the DeFi language, but also be institutional grade as well. So, and then of course, security. So the protocol thing, I guess or the technology piece is a complicated piece to ask because there are so many different layers to the stack. But I think one of the reasons why we're seeing accelerated adoption is that at all layers of the stack, including at the protocol layer and companies like us that provide other services, you're seeing that continued maturity of both product and technology.
Yep. And I think that's a great segue to get into the use cases. So let's each of you, can you tell like specific examples of how institutions are currently utilizing your platforms?
I can go first. So I'll give two examples. So one is on the regular stablecoin yield side. So we have a professional asset manager. They manage some money on behalf of foundations. They deposit stables with us. So they're effectively a lender of stables. They're currently earning about 11% APY, which is very compelling versus traditional finance or traditional credit. And they can withdraw that money within 30 days notice if they want. Typically, we're doing redemptions within a couple of days. And so they use it as a pretty straightforward yield product, effectively a form of kind of like private credit allocation on chain. But another use case has been more recently, we launched this Bitcoin yield product. And so an institution who is holding Bitcoin at a custodian can, no longer has to earn nothing on it. And I think this is indeed part of Thomas's mission with Function, but they can earn in-kind Bitcoin yield with us. And so that's a really powerful motivator when you consider that there's very little other yield opportunities on Bitcoin at the moment without taking kind of significant counterparty risk. And so we're able to do that through staking on the core network. And what we do is we manage hedging, we aggregate and manage the kind of the staking the staking operational process, and then we perform the hedging so that they can receive that yield in Bitcoin. One further one, and then I'll stop, was there was the Sol unlock from the FTX estate, and so we actually lent to some firms who participated in that discounted OTC sale that vests over a period of 4 years, but we lent them Sol so they could hedge that transaction, and took as collateral locked Sol that remains in custodians like BitGo. But that was a very interesting kind of institutional hedge case that provided a great yield opportunity for folks in Sol in kind.
Yeah, I could give two specific examples as well. One that paints a picture of institutions, and the other one paints a picture of retail. And it also just around like how do we get utility or yield on BTC, right? So for us, one core demographic are miners. They have to pay off operational expenses or whatever they want to do with the BTC, right? Except that they're not natural. If they can help it, they tend to not be natural sellers. So what they can do is they can deposit FBTC on Avalon today, and they can borrow USDT at a fixed percent rate of 8%, right? I think especially in a bull market, this is highly attractive, and it can take an institutional size. We're also very interested in trying to replicate a version of this with Maple, because if you think about Avalon as like the Eastern hemisphere's institutional lending marketplace, Maple, of course, in my mind, is the Western, and we definitely want to have a presence and a strong partnership there. On the retail side, things get a little bit more degen, if you will. So I'll map out one flow that we've seen. So today, users can convert from BTC to FBTC on Bybit and get 2%. From there, they can take it to an on-chain vault that we have, where effectively it goes from FBTC into USDT, and then goes into Athena for you to stake, get a return, but also farm the points. So those are two very distinct paths based off different risk profiles and appetites.
Yeah, for us, our anchor is staking. So, but native staking for institutions, but on the DeFi side, MSOL is a choice for some individuals and also some institutions looking to do some things in DeFi with MSOL, whether they're looking to do their own lending strategies or multiplication strategies. So you can take MSOL and then you can borrow against it, and then stake some more MSOL against what you borrowed, and kind of loop it that way to multiply your yield. Some institutions do that themselves. Some of them use products like Camino to utilize MSOL that way as well. And many, of course, work with Maple as well. So, that's more of the DeFi side of staking yield, where people are able to do some interesting and creative things with liquid staking tokens.
And what are there, beyond, in general, what are other innovative use cases beyond yield farming or liquidity provision?
Really, borrowing and lending are the broadest ones.
I was going to say, Sacha, that's a taboo question. Nobody dares to ask. But I think as institutions move in, right, you're going to have more, just the space is going to increase, the amount of Bitcoin in circulation, and the volatility will hopefully decrease over time. And once you get to that more of a normal state, you can start seeing more structured on-chain products. For me, it's exciting if you can find some sort of Bitcoin-based fixed income strategies. Those are all very interesting. And it's a good sign that the institutions are coming in, but also Hadley and Sid and folks like myself, and probably others on the call, are doing the work to build the infrastructure that will pave the way for new DeFi primitives eventually.
And then I'd also say DeFi primitives merging with TradFi and vice versa. I think that's where there's a lot of green space to be filled in, where you kind of have these two worlds, TradFi and DeFi, and expertise in those two worlds. Obviously, TradFi goes very deep, DeFi more and more, but then how do those pieces overlap? And how do they not just overlap in terms of features and functions, but also creating potentially new products that couldn't have been created before?
And so on that, what is often missing from traditional finance products, right? They can be leveraged with DeFi.
I'd say some of it relates to speed. Some of it relates to time. Obviously, the 24/7 element of DeFi is very different than how TradFi operates. And then it's the ability to maybe remix and create new products that couldn't have been created before.
Yeah, I think speed is super important. So I mean, in lending, we can settle on a weekend, we can settle at 2 a.m. If we want. Whereas in traditional finance, in private credit and lending, you can only settle during banking hours. There's also no marginal cost for us in serving clients in Japan or the UK or the US or South America, whereas in traditional finance you have to set up bank accounts and there's a lot of infrastructure that goes into dealing with clients in different regions, whereas the fact that your wallet is like an email address for money is very powerful in onboarding new clients and serving them globally. And then I would just say a super important one is transparency. Like, traditional finance is so opaque when it comes to the flow of funds and what the different stocks and balances are at different institutions. And you only need to look at this in credit, where in 2022 we saw the CFI lenders went under, and there was no visibility onto collateral, performance of loans, how much equity there was to backstop losses. Whereas on chain it was super transparent, and I think that's one of the elements that where DeFi has a real advantage over traditional finance.
Yeah, DeFi is like the community kitchen, right? Where the ingredients are all there. Anyone can come, they can remix it quickly. And you also get immediate economic feedback as to whether or not this works or doesn't work. So I think it's a experimental proving ground, so to speak, and it drives new ideas, right? Staking in itself is a pretty DeFi specific thing that was born from primarily ETH, right? But that's a new vector or new increases. I think it just increases the surface area of the types of financial products that TradFi can tap into.
Yep. And so how, as an institution, how do you balance both, right? I mean, all the opportunities that are presented with DeFi with all the risk management requirements?
Again, there's so much more maturity in this space now with, from a compliance side, there's so much precedence and, vendors like Chainalysis and Elliptic out there that serve those functions. There's ways to manage risk, both from a security standpoint, but also operationally. It's not necessarily straightforward, but it's not straightforward in TradFi. And to Sid's point about transparency, in some ways things are easier with the adoption of the technology. So how do you do it? You do it with smart people working with smart partners, and you start building. And I think you start building small and experimenting and learning as you go. I mean, I can't help but it's a similar question to what we had at Fidelity back in 2014 when I first started there, when there was nothing. And now what? Fidelity is, I think, the second largest Bitcoin ETF. Does self-custody for that ETF, does custody for ETH, has launched ETFs, does a whole bunch of other products. So, and probably has about 1,000 people there working on digital assets. But you don't start with 1,000 people. You start small and you learn and build along the way and get smarter and smarter. And in that way you innovate. And before you know it, you have some kind of competitive advantage.
I think Fidelity is a great example. And just full disclosure for clarity, FBTC has no relationship with the Fidelity ticker FBTC, except it just shares the same 4 letters. But it's like what Fidelity did. I remember when we were talking to Fidelity back at BitGo, but it's starting with what right? I'm a little biased here, but start with Bitcoin. Institutions already hold more Bitcoin than Satoshi Nakamoto, right? So start with Bitcoin, and to Hadley's point, figure out what you want to do with it instead of looking at all the technologies out there. And then don't try to build everything in-house to start, right? There's some things that you want to leverage that are tools that are already out there that have the Lindy effect that you can measure the risk and integrate with, and then just slowly allocate over time. I think Fidelity started with BTC, now it has ETH, now it has trading. Who knows? Maybe it'll start adding Solana and a couple other assets in the future.
Yep. Yeah. So as you mentioned of now what's being added, let's in the last couple minutes we have, let's look at the future outlook for DeFi. So what do you expect to see by the end of 2025 in terms of DeFi institutional adoption?
Yeah, go ahead, Sid.
You go, Hadley. It's fine.
I would say I would expect by the end of 2025, Solana will continue to be the chain that institutions build real-world assets on and deploy more real-world assets on that chain. And then I would expect to see, even more funds, trading venues, et cetera, that are set up both in partnership with companies like Maple, but also internally as well, as institutions get more comfortable working with these assets.
Go ahead, Sid.
I was going to say, I expect to see stablecoin issuance, continue to grow. Maybe it's not at 500 billion by the end of the year, but I think we'll probably add another at least 100 billion. And I think that's like a rising tide that kind of lifts all ships in DeFi, because all of us, kind of depend on stablecoins to transact, and that drives the flow of really drives the valuation of a lot of DeFi assets as well. And then I think you'll see some TradFi institutions participate in the tokenization of assets other than just money market funds. So I think that will be a really important driver, and it's indeed a really important way for them to kind of dip their feet in the DeFi ecosystem, whether it's tokenization of a fund or equity or real estate. But I think that combined with continued stablecoin adoption, and I expect to see that institutions like Cantor will have fully launched their lending products against crypto assets before the end of the year.
Yeah, I think we're following the Gartner hype cycle at the moment, and AI has the attention. The Bitcoin attention has passed back when when Bitcoin was ETFs were first launched, but I expect to see continued maturation of Bitcoin ETFs. And when institutions, especially in the West, are holding these assets, they're going to expect to figure out how to generate yield on these holdings. So the yield conversation will naturally follow as more institutions enter the Bitcoin ETF conversation, which then leads me to believe that I can expect a surge in Bitcoin use cases as well in DeFi, whether it's borrowing, lending with Maple, or as we move to a more risk-on environment, it could extend to Solana as well.
Yeah, and I guess my next question for you guys is kind of twofold. One is, what about L2s? What do you think about the evolution of layer 2 scaling solutions? And sort of the converse is, what's the role of cross-chain interoperability for institutional DeFi adoption?
And I'm going to be a bit provocative here and say that L2s are for L1s that don't work. So, I think they're kind of a distraction, and Ethereum has to figure out exactly what it's going to do. But I think an L2 should never really have a reason to exist on a performant and secure blockchain. I do think in terms of interoperability, the things like Thomas is doing on Bitcoin and across other chains is very interesting. So I hope to see a move away from the L2 phenomenon and more focus on things like Wormhole and other protocols that allow this kind of protocol to protocol communication. But I feel sorry for the L2 ecosystem.
I think the industry joke is what ETH is just a testnet for Bitcoin. I by no means a Bitcoin maxi, but I think Hadley is right. I think institutions, they don't really care, right, whether it's an L2 or L3 or whatever the heck it is. They just want to know how to access the liquidity and the yield there in a safe and compliant way. So in a way, to me, there were some certain assets that they care about, but they really more care about how do I access that alpha or that yield in a way that fits my mandate.
Yep. And Sid, do you want to add anything on this? On L2 solutions and cross-chain interoperability?
I think we get pitched a lot on kind of joining new chains, and whenever we evaluate it, it comes down to a decision of TVL. I think in 2023 there was definitely an overinvestment in kind of new infrastructure, so L1s and L2s, and I think that kind of got ahead of the actual use case. So you've seen more chains really trying to split the same number of users or the same TVL, and so I think that's been problematic. I think where we're seeing some kind of green shoots are when you have an app that has a lot of users look at kind of creating their own app chain, whether it's an L1 or an L2. Like I think the most recent example was Athena with Converge in partnership with Securitize. Like they've already proven that they can get to billions of TVL, and that's more than most L2s have on them. And so I think I am less bullish on the kind of the fat protocol thesis, and I think it will be fat applications. And so I think really most of the value in terms of L2s and traffic is just going to accrue to a couple of chains. We've seen that Base has taken a lot of the traffic from the other L2s on Ethereum, and indeed there's some concern from the Ethereum community that Base could go off and create its own L1. So I do keep watching the space, but I think it's more important to just kind of track and follow where the TVL lies, and that's ultimately what attracts institutions, and that's why Solana is doing well, and it's why a lot of people are still issuing stuff on ETH mainnet.
Awesome. And so as we're nearing the close, let me ask you one or two more questions. So let's say you have an institution that comes in, right? Like, what advice would you give them about considering entering the DeFi space if they're still hesitant?
I would say do it yesterday. And kind of on my comments that I echoed before, start small, but start meaningfully. Given that institutions are most concerned with regulatory security, have those teams partner with your internal teams. But it's also very different now than it was in 2018. This industry is now 10 plus years old. There's a lot of people out there with a lot of experience, including institutions that have launched mature products. And those are companies that you can partner with, like some of the companies on this call. Those are also, companies that you can partner with and maybe hire from and build your own team. So my advice would be to get involved yesterday and doing it in a meaningful way.
I'll go. I think launch something in kind of a smaller way. I think a lot of these institutions spend too much time. They're mostly held up at the legal stage, right? Like they'll have a compliance person who wants external counsel to review everything, and they largely just don't set a foot down because they're too worried about that risk. So I would say just they ought to decide basically a kind of marketing budget of assets they're kind of willing to put at risk, whether it's like $100,000 or $1 million, and treat that as just kind of like R&D money, and then test out a product themselves. But I think what I've seen is that there have been so many kind of offshoots and teams coming out of TradFi, institutions that were trying to do a blockchain product, but they take 12 months to kind of get nowhere. And the best ones, I think, actually launch something as quickly as possible.
Yeah, narrow the scope, start with something specific. And I think oftentimes you have to get it, right? I remember the aha moment that I had when I first started interacting with the MetaMask wallet years ago, right? So I think to the institutions, if you don't have someone who's leading it, who's actually active in the space, it's going to be very hard to sell the value proposition internally to really realize what DeFi is and the implications it can have on your business. So dedicate someone, or if you have a team, have them participate in Marinade, right? Or participate in Syrup, or heck, get some FBTC, right? Like start playing around and you can start seeing the power of DeFi and how it can be complementary to institutional strategies.
Yeah, use prop capital and allocate somebody who can just kind of work on a discretionary basis.
Mm-hmm. And now other way around, you have a DeFi participant or that comes to you and like, what would you advise them to do to better meet the need for institutional participants and be ready?
I guess the flip side, which is while the regulatory environment has changed, don't ignore it. The compliance environment hasn't really changed. And so if you don't have a good answer for how institutions think about compliance, and then same with security, you have to think about security from an institutional mindset. And then on the product side, I guess it's just be willing to have a lot of conversations and be very patient and be passionate about sort of educating our TradFi counterparts on how this technology works, how it's different, how it's the same, and what the opportunities are.
It's funny because I sat opposite Hadley at BitGo, so I know how that conversation went. It was a lot of education, right? Not just to me, but even internally navigating the product teams and the accounting teams, the finance teams, right? So I think it is the integration points that matter, but also you have to make it super simple. Like I think there's a curse of knowledge when once you get into DeFi, all these concepts are clear, but you got to revert back to, if you're talking to someone who hasn't spent a lot of time in this space and take them through it. So the easier the value proposition and the less friction there is to deliver whatever it is you're trying to deliver, the kind of quicker decision loops that these institutions can make.
Yeah, I think having kind of like robust compliance and legal answers is probably one of the most important things we found. And then just like bringing them customers, there has to be a clear kind of value proposition for them. And I think a lot of people go in and try and shill what they think is great tech without any real sort of business use case for it. So I'd say those are the number one and two things. So good answers on compliance and legal side, because you will get a ton of those questions, and then just a clear way that it makes them more money or gets them more prestige somehow.
Thanks, and thanks for such an insightful panel. That's very exciting to see what's going to happen at the intersection of DeFi and institutional finance. So just before we wrap up, I'll give each of you a quick opportunity to tell any final thought and where we can find you. Sid, let's start with you.
So you can find me. I am on X at SyrupSid, and we are at Maple Finance. You can find our website, maple.finance, and reach out there if you're interested in either of the yield products. So, paying currently like 11% on stables, and then we have a product that's paying around, call it like 5-ish% Bitcoin on Bitcoin yield. So if anyone's interested in that, just head to maple.finance or DM us on X.
Yep. For me, I'm on LinkedIn. On X, I am Thomas_FXIN, kind of shorthand for function. The website is fxin.xyz.
Yeah, I'm Hadley Stern on X, very creative. You can also find me on LinkedIn, and Hadley at Marinade.finance if you want to email and have any questions about, want to talk about Solana, want to talk about Solana staking ad nauseum, I am your guy. So happy to have any conversations about Solana and staking.
Awesome. Well, thank you so much, everyone, for joining today. Thank you to the audience. And this concludes our The TIE Innovator webinar on breaking barriers to institutional growth in DeFi. Thanks, everyone, and see you next time.
Thank you, Sacha.